if you got a term sheet from one of our competitors for a Fannie Mae loan, we can't turn around and give you a different execution.
Yeah.
So from Fannie. So you could really muddy the waters if you just submitted a deal and didn't have someone go through your underwriting with you with a fine-tooth comb to work through it. And then we're all in a bad position because, potentially we could have gotten you a better deal.
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else with your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grinzik, and with me, John Cohen. How you doing?
Doing good. Thanksgiving, day away. We got a great guest in the office, brought us great food. 2 guests. Brought us a great spread for breakfast. Starting our Thanksgiving early. Exactly.
Petition Toro to start doing this every morning.
I know that's a problem. Now these companies, they do that. They bring in food, like my cousin, my dad. They're like, oh yeah, we get this spread and everything. We don't even pay our employees. So
or we'll just tell any guest that wants to come in, hey, you want to come on, you better bring a spread.
Exactly. You guys, you set the bar. Always setting the bar higher.
Yeah, but I'm excited. We got 2 great guests on. Do a lot of our debt on our properties from Walker and Dunlop. I'll let them introduce themselves a little bit, but we got Jeremy Nussbaum and Ralph. How do I say your last name? I'm sorry. Wurzburger. So thanks for joining us, guys.
Pleasure.
Awesome.
Thanks for having us, Chris and John. Great to be here. Had the fortunate time to work with you guys now for a couple of years. Really been great. Happy to be here and spend some time with you guys. What should be a quiet work day, but probably won't end up that way.
No,
for sure not.
It never does.
So,
and I can start very quickly. So Ralph, I met Ralph 5-6 years ago, probably. Ralph was at an event I went to, handing out $2 bills. I think, right? Dollar bills? Yes, you were.
That was my competition.
Okay, well, no, but you were there. You used to go. The point of the story is not that you were giving us $2 bills, is that it took 3-4 years of Ralph harassing me before we ever gave him a deal. But it was persistency that you basically you wouldn't stop. You didn't stop.
I've listened to your podcasts. You really said the one that squeaks the most gets oil.
There you go.
Close enough.
Yeah, no,
not quite.
But no, it was. They've become an extremely valuable tool for us.
No, for sure.
On our deals. Our other lender that we worked with, our mortgage broker that we worked with for forever before, they threw a Hail Mary on a deal and it landed with the best terms. And then since that, you guys have gotten a lion's share of the business. I keep everybody happy and you give and take.
As best you can.
As best I can. But it was persistency. I mean, he would not stop calling me. I probably answered his calls, 1 out of every 200-300? To give or take.
Yeah, good ratio.
So it's interesting when we started out as Deerwood and Ralph eventually came on and joined us. I had started going after John also. Didn't have as much success as Ralph did, at least having conversations and things like that. And Ralph came in and we're like, let's try to see what we can do together.
Yeah.
And it worked out nicely. We threw out a Hail Mary on our first deal. We had what we thought was the best term sheet. Didn't end up winning the deal because your other relationship you just felt more comfortable with, and then you had that whole one of the bridge lender shop shut down. They ended up going up to the group that we had a bid from, and it's funny how things turn out a couple of years later.
It was crazy because our other debt guy, and we're definitely going to try and get him on here once, because I do like Chris. I mean, he's a great guy, but his contact at another group literally, as they presented the lender to us, just moved over there. So when I brought it up to our other, to Chris, I said, hey, what about this group? He's like, small world, but yeah, I know the guy there too. So you're in good hands. And they played nice in the sandbox together. They did not hammer us on fees. They split it. They played very nicely, and that was greatly appreciated. But it was just crazy how, that Hail Mary turned into, what, I consider a very good relationship. Even after that, I mean, they're very extremely valuable. They've been extremely valuable to us. I mean, they got and I'm sure we'll talk about it shortly, but we got an extremely complicated deal to the finish line.
No.
That, I had to threaten a lot of people for that deal to get that. Ralph didn't get threatened, but I know Jeremy did a handful of times, but It was crazy.
very cordial emails.
Yeah. Before we dive deep in the rabbit hole, I'm going to ask each of you to spend a minute, 2 minutes, just who you are, what you do, where you're from, little introduction.
Sure.
Whatever you want to do.
Jeremy Nussbaum, Senior Vice President, Walker and Dunlop. Original platform, we started out as Deerwood Real Estate Capital, which was an offshoot of Meridian Capital, started in 2009. And then Walker and Dunlop, as we grew out our platform, we were doing about $2 billion a year in originations across the country. Walker and Dunlop bought us mostly for our capital markets, really platform and expertise. Our shop alone was doing about the same amount of capital markets business as Walker and Dunlop was doing across all originations across the country. So it was big value add there. And they wanted the Northeast exposure, try to break in through the agency side in our platform there, where we'll be the second largest agency lender this year in the country. And since then, we've actually done a couple of really very nice large agency deals in New York City that probably in the past Walker and Dunlop never would have had a foot in the door to get. So I think it's worked out really nicely. Walker and Dunlop shares are through the roof, and I'm sure that's making many people very happy. Our office should do, I think, over closer to $3 billion this year. So we've grown very nicely. It's been a great platform. I've been sitting in the same chair now for about 7 years, and
Must be a good chair.
Yeah, so far so good.
Awesome. Thanks. Ralph, you want to give a little minute on yourself?
Sure. My name is Ralph Wurzburger. I'm the Vice President of Walker and Dunlop. I started out initially in the mortgage industry by Meridian Capital, which was an opportunity for me then. I've always heard great things about the Deerwood Group. About Abe Cass, Dave Rosenberg, they were very respected. And then I discovered Jeremy worked there. We grew up together in Muncie, New York. We were neighbors. We actually shared a side yard. And Jeremy got me in the door over there. And it's been a success. When we paired up together to get your business, I started pairing up with Jeremy on a lot of things. And thankfully, it's the third year in a row we're scaling over, at least for me personally, over 100 million originations and closings, which I'm thankful to Jeremy and you guys also.
Yeah, awesome.
Definitely gave me exposure to new markets.
Perfect. So just a little background for everybody listening. What types of deals you work on? Where do you work on? What do you guys specialize in something? Give a little background on, obviously all debt, right? Just no equity or other types of capital, very little, if any.
Right. So yeah. So sorry.
People got to hear you. They can't see you.
No, exactly. So we're definitely, I wouldn't say exclusively debt.
Okay.
I've done a couple equity deals. I've done debt deals where there was participation. So there's, going up the stack, maybe getting up to kind of high 80s or 90s on different deals. We really play in all asset types.
Okay.
Office, industrial, retail,
Gotcha.
multi, obviously. Obviously, as Walker and Dunlop, we're direct lenders. Fannie Mae, Freddie Mac, HUD on the multifamily side. We also have a balance sheet for transitional multifamily deals. Not every deal fits our in-house profile, so to speak. And we grew up, so to speak, in the business as brokers. So that's definitely still a very large part of our business. And I would say most of our business. We're doing deals all over the country. This year should end up with about 25-ish closed transactions, ranging from California to Texas to all up and down the Southeast, which has definitely been a core market for us and for you guys as well.
For sure.
And obviously a pretty good amount of local business here. But we really also play in all aspects of the debt in terms of lender type. We do a lot of CMBS business. We play very heavily on the bridge side. And as we've done with you guys, both lighter value add and then, very heavy, very heavy value.
Very messed up stuff.
Right, very heavy value add.
Sure.
And then again, life company. So another one of the big advantages we had when we got bought out by Walker and Dunlop, we're correspondent with over 50 life insurance companies across the country. That's not an outlet we had before as Deerwood. So that's been really great as well. And then the agency platform we recently opened, we're about a year into our Fannie Mae small balance program, which has been really great. We rolled out like a quasi bridge to the Fannie Mae small balance platform as well, which is, getting tweaked to make it a little bit more viable and productive for guys like ourselves. But it's been great. Interest rate environment's amazing and everything else.
So I got to ask, because this is always a question that I had early on in the early on in the business, when you meet a lender, everyone's the number one lender, right? Everyone says they're the best. We're the number one agency lender. We're the number one. Why does everyone say that? And obviously everyone can't be number one, but how does that debt side work? Because I think the debt world, even, the three people that we have working for us on the cold calling acquisition side, we're looking at a deal, they bring it to me and I'm like, throw a 4.25% rate in there, throw a 5.25% rate in there. Like, how do you know you can do that? Or how do you understand you can do that? Or one, I've been doing it long enough, but when someone's listening, debt is, it's all over the map. Why does everyone say they're number one is the first question. And then two, what distinguishes how that's, how you give yourself that title? Because you guys didn't. At no point was there a call from Ralph or Jeremy that said, we're the number one agency lender in the world. That was never part of the pitch, which is one of the reasons why I like you. You didn't get that bullshit lie. But how does that work? How does that ranking system, if you want to call it, go?
So you could always find something that you're number one in. I have number one customer service. My client told me I'm number one, right? Typically when we're giving you number two, it's volume.
Okay.
It's strictly volume in regards to our agency platform. So this year we'll do 20 plus, I don't even know what the number is, but probably north of $20 billion between Fannie, Freddie, and HUD. Mm-hmm. And that's just strictly volume. So when we say we're the number 2 Freddie and we're the number 3 Fannie or whatever it is in any given year, and we're typically somewhere in there, number 1 Fannie, I think 2 years ago, whatever it is, it's just strictly volume. And that's a number. But again, how does someone else say they're number one? Someone else can say they're number one in HUD. So they're going to come out and say that they're the number one, lender. And then in fine print, you'll see exactly what it is. Mm-hmm. Someone can be the number 1 Freddie and someone can be the number 1 Fannie. And then another lender could be neither number 1 Freddie or Fannie, but number 1 overall. So everyone can
everyone's number one.
Everyone's number one in some way, in some way, shape, or form. The biggest, I think, the way how you try to differentiate yourself on the agency side, which is really right. Ultimately, we're all DUS lenders. We're taking our package and we're submitting it all to the same group. Conceptually, we should all get the same bid.
Yeah.
Okay. Right.
But it doesn't work that way.
It doesn't work that way.
Arbor, CBRE, great, all those companies. One guy will be not a quarter point, maybe a quarter point, but a quarter point lower on the rate, or maybe you get an extra year of IO. So there is differences
100%
between the groups, but why is that?
It's relationships with the agencies, I think, is a massive part of it. A lot of that comes with volume, understanding what the agencies are looking for, but it's also how we underwrite a deal. And I think that's a really big part of it. Our servicing portfolio is now over $90 billion in assets across the country. Mm-hmm. No matter pretty much where you're buying a deal, the amount of comps we have that we can put together and look at and really break down your underwriting. And we're going to have conversations with you. Why are you budgeting, $1,200 a door for R&M? Our comps are showing us, we should be at $900. And so it's things like that where we try to help our clients build a pro forma and a model that's going to maximize their debt. And I think really those two combinations, how to really underwrite a deal and underwrite it as tight as possible while still understanding how the agencies are going to look at that underwrite.
Yeah.
And that's what's going to differentiate. The biggest thing and a misconception that we get from a lot of clients that they're not aware of, once a deal is submitted to Fannie or Freddie, lock the door. It's over. They're locked into that quote. So if you got a term sheet from one of our competitors for a Fannie Mae loan, we can't turn around and give you a different execution.
Yeah.
So from Fannie. So you could really muddy the waters if you just submitted a deal and didn't have someone go through your underwriting with you with a fine-tooth comb to work through it. And then we're all in a bad position because, potentially we could have gotten you a better deal.
For sure. Can you just, for anybody that's newer listening, can you break down in 60 seconds kind of like the high level process of how it works? If I come to you with a deal, like I do this, and this, because from someone in my standpoint, it's I hand it to you and then, I know some of what's going on, but I may not know anything or anything. Just kind of high level. How does it work on your end?
Sure. So someone calls us with any given transaction, right? Again, depends what kind of deal it is, but we'll just say agency.
Keep it simple.
Right, keep it simple. We're gonna ask for a T12 broken down monthly. Extremely important on the agency side for a T12 to be broken down monthly. You get these full T12s that have no breakout, create a problem. Why? Agencies underwrite T3 on the income side. There are times where we can get a waiver, if it's new construction or there's a reason why a T1 number really should hold more value than a T3. We can make that happen. So we can do T1 collections on, let's say, a new build coming out of construction that's just stabilized. And then on the expense side, we underwrite T12. And on other income, we also underwrite T12, which is a nuance that not everyone always gets. Obviously, we're going to take that. We're really just going to put it into our own model, run those numbers. We're also going to get a pro forma from you. So if the property, let's say historically has been operating, let's go back to the R&M number at $1,200 a unit R&M, and your pro forma shows $900, we're going to take a look at our servicing portfolio. We might ask you, hey, do you guys run any comps in the market that you can share with us? And that there's no better data than your own, right? Sure. Especially within that market, or even if it's in another market, but a similar vintage and whatever it might be. And typically with agency deals now, we're typically not LTV constrained. We're more typically debt service coverage, and that's going to be driven by market. We're normally at a 125, depending on the market. You could be at a 130. You could be at a 135. And obviously that also ties into pricing, right? So how tighter pricing we can get, the more proceeds we can get. But that's really, we throw it into our model. We try to underwrite tight. We always come back to you with questions first, right? Because it's got to be a dialogue and a conversation to make sure we understand what it is the goals are and how you're underwriting it. And we'll come out with a loan amount, a high level rate, an IO. We're giving you our look at it. And then on an agency deal, we're always going to submit to both Fannie and Freddie. A lot of people think they're like in cohorts with each other. They're competition. They want to beat each other up and win deals. And it's our job to have them do that.
Awesome. And then how does it work a little bit further forward? Obviously, you get on the same page with whoever's asking for the transaction, and then you submit. What's that process look like? How much, back and forth? How much, leeway? We're talking about some people get, better or worse depending upon relationship. How does that work? And then, how does somebody figure out how, the person I'm going to, whether it's you or somebody else, that's doing the same thing as you, how do I figure out, their ability in that regard?
Yeah, sure. So when you're actually going to submit, so again, only one group in theory can submit to each agency, and they're trying to do that so everyone's not chopping each other's heads off. Fannie and Freddie actually have minimum earning requirements on every loan for every originator. They don't want you getting so skinny that you're not making any money.
So that means that you are the originator and you have to make a certain amount to submit, correct?
The originating company, correct. So Gotcha. And you can make that money either as an upfront fee, right? Or you can get paid as a premium in the spread. Typically, we like to keep the pricing as tight as possible, because especially if you're doing an agency loan and typically it's a long-term deal, the value benefit over 10 or 12 years.
lower rate, pay it up front. Right. Every deal we've done on the agency side, that's what we do, because you have a 4.2 rate instead of a 4.4 rate or 4.3, whatever it is.
Correct.
Those 10 basis points over a $20 million loan over 10 years, that's going to add up.
It's really a no-brainer. I would say the only time you ever see anyone really say, I don't want a fee, is if, either A, it's someone who's trying to make sure they don't fee their investors, and they start asking questions maybe about their own fees, whether it be acquisition fees or anything else. The investors feel like they're getting feed to death. So that's really the only time we see it. But otherwise, so you have your coupon, and we're going to try to get that as tight as possible. We have to put together, really, it's pretty much like a full credit memo into the agencies when we submit. So we have kind of our own little book, and there's CoStar reports, and there's pictures, and there's comps, and there's...
So that's something that nobody knows on the debt side. People think like you walk into the bank and you're like, here, lend me money. But the books that the brokers put together, because I'm gonna give credit to the brokers here, because they put together a very substantial book on the borrower. It's, their resume, their track record, deals they've done together, CoStar reports. It's not you just walk into the bank and say, "Oh, can I have a loan on this property?" Because that's where, you can do that, but you're going to get smoked. I mean, your rate's going to be worse. Your proceeds are going to be worse. They put the best story together as a broker would put a package together selling a deal. They do the same thing. Mm-hmm. So their time is worth, they can't do everything for free because nobody wants to pay anybody anything. That's the rule. But there's a lot of work that goes into it. And that's the work that, and correct me if I'm wrong, that's the work that you guys do up front, which to me, I can go to bed at night knowing that I'm going to get the best term sheet, whether it's Fannie, Freddie, HUD, Bridge, private money, insurance company, whatever product it is, that book's going to everybody.
Yeah, and I mean that's part of what we need to do. So the agencies, we have like an airtight presentation that we're going to put it. It's going to look the same every single time, because again, the agency is kind of one. It's got to fit in that box on some level. Obviously, there's ways to maneuver that box in the agency world, but it's got to fit into that box. It's going to be a stabilized deal, pretty much for the most part. And we can get into some of the other, agency products that maybe everyone isn't so familiar with. But so the agency model is pretty standard, and we have the standard transaction book that we're going to put together and submit to them. And it's going to have a tremendous amount of information. And we're really going to try to drive home the points that we feel are most important to getting the transaction to where we need it to be. So, if one of the things we're doing is we're taking a really tight underwrite on expenses, we're going to really harp on that. I actually just bid on a deal that we ended up losing. And I thought we did a really, really great job getting as tight as possible on our bid and being extremely creative with how we underwrote the deal. Not every deal works out, certainly. But that's really a big part of it, is not just, okay, now we figured out how to underwrite it. Now you got to sell it. Right. Yeah. When we're talking about capital markets, the presentation, the book, that really comes into, I would say that's more us figuring out how to structure a deal, how to put it together, and how to sell that to fit your business plan as a client.
Well, I think the whole package and everything comes back to like the basics of investing is risk versus reward, which a lot of people don't think about, especially when we talk cap rates to newer people. They're like, "Oh, why wouldn't I just take a 7 cap instead of a 4 cap?" And I'm like, well, it's riskier. That's the whole metric of it. But it's the same thing where, if a broker puts together, I don't know how many pages it is, 50, 60, 30 pages, that's going to take a lot of the risk away from the lender. They're going to be more aggressive on their term sheet, which is in turn going to turn around and get you a better loan, correct?
Yeah. I mean, right. You want to get guys comfortable, and information makes people comfortable. Yeah. But quality information, right? Too much fluff in a book, they start going through the book and okay. Right. So it's not just, a quality presentation that's focused on what's important, and then jumping on the phone with these guys, talking through the deal, selling the sponsorship, selling the market. Yeah. That's the kind of work really done, I would say more upfront rather than just pushing paper or getting transactions through, overcoming hurdles as they come up in a transaction. But that front process, getting guys interested, getting them comfortable, and getting them to where the client needs them to be in order for the deal to make sense.
Yeah. I mean, it's the same thing on the equity side for us. And we're putting together a 50, 60 page book, and it's following up with people and getting on the phone and making sure that they understand what's going on. And, if they're looking at a T12 and your expenses are dropping by 10% or you're increasing them 40%, why is that? And how does that affect, the deal? And one of the deals we're doing right now is a loan assumption. And, we've had a lot of conversations explaining why, we're taking a loan that's paying basically 5% when an agency loan at 70% is down near the 4s and no interest only. And there's a good reason. Their cost basis is much lower, but it's explaining that to people. And once you get them on the phone, some people don't like it, and a lot of people do because it's a good reason for it. But it's, it's interesting to hear that it's almost the, parallel process for the debt side.
Well, because I get the question all the time, why would you pay a broker a half a point, a point and a half, whatever? Why wouldn't you just do it yourself? It's like, well, if I'm doing that, and then it's just not a good use of my time, because you're buying a $20 million deal to nickel and dime $100,000. if you can't afford the deal for $100,000, you're trying to save $100,000. You're probably not buying the right. You're not buying the right deal. So, I know that when I give it to the broker, it's going to get done how I need it to get done, because those are the conversations you have up front. The first call is, hey, what do you think we can get? Here's a deal. What do you think? I think I can get you, agency debt at 4, 3 years IO. Okay, great. I model that out. Wow, the deal looks really good. Now use that product. But the other thing brokers do, that's the whole upfront transaction. The other thing brokers do is they look at the deal and say, wait a second, have you thought about maybe doing a bridge option? Have you thought about, a 10-year IO, 60% leverage deal? They've done so many. You're doing 1 or 2 deals a year or 20 deals a year. They're doing 25 themselves plus the whole entire company. So they can look at a deal with another set of eyes. So if you're paying them, you're not just paying them to go get you the debt. You're also paying them to help you structure, underwrite, and do the deal. Well, we can do this, this, and this. Your cash flow is better. What are you trying to accomplish? Are you trying to sell us in 2 years, or you don't want a 10-year agency product? It's going to be completely, you can't sell that. It's not sellable per se. But that's the other thing that any broker does, that, and where you have mutual respect and feel confident, that group's going to go to bat for you the most. Can you speak to that side where maybe a guy brings a deal to you and wants a bridge? You look at the deal and say, that we could probably go get you this type of loan. I mean, I don't know how frequently it happens, but can you touch on that, where you've helped clients make significantly better debt decisions given what their business plan is or what their goals are?
Yeah, I mean, it happens a lot. Whether I would say across all asset types, sometimes depends on the sponsor's model. Are they like a true syndicator, right? That's going to drive a lot of it. What they're looking to accomplish from the deal. Are their equity guys more IRR driven? Are they cash on cash driven? That's gonna push the situations. But a lot of times clients necessarily don't maybe even understand the full breadth of the options that are out there. And it's our job. And I'd speak to that, guys who prefer to go out, I have an agency relationship, and, I know a bridge group here, and I know a CMBS guy. I don't need a broker. I could tell you. So myself, I'll do 25 deals this year. I work in an office where we're probably going to do 200 to 250 deals. And I may not know about every deal, but I know about many of them. And then, of course, obviously across a much larger platform, Walker and Dunlop as a whole, with, 250 originators closing, I don't even know how many loans all year. What we see in our exposure to deals and understanding how to overcome hurdles on deals allows us to try to upfront see how things might work out. You might come to me and say, hey, I want this kind of bridge loan. And I might tell, well, you know what, this property might need something a little bit more flexible even than a bridge loan that's going to get securitized, because you need a true balance sheet lender that's going to, work through with you on a super heavy CapEx budget and a property that needs an interest reserve and maybe an operating reserve and all sorts of different kinds of structures. So it happens all the time. I mean, one of the more frustrating parts as a broker is when you get a client who just flips you over a deal and says, I don't have time to discuss it. Well, so like I can read an OM, right? And I can look at the numbers, but without understanding really what it is that you want as the client, doesn't allow us to steer the ship. So I can come back to you and I'll say, well, if we decide to do an agency execution, it's going to look like this. CMBS execution is like, look at this. Bridge, it might look like this. I don't know what you're looking to accomplish, so I have no idea what direction to start to head in, and even to have a conversation as to how I want you to go back and look at the underwriting and make tweaks. So it happens a lot.
Yeah.
And, really, really very sponsorship dependent and how the deals are structured and what's looking to be accomplished.
Now, when you guys bring a deal to market, on the debt side, I know every deal is going to differ, whether it's agency or bridge, stuff like that, but what can a client expect back from you guys, where it's like, if I go do this myself, am I going to get 10 term sheets, 5 term sheets, 30 term sheets? I know the deal's going to dictate, you want an agency loan, you're going to get a couple, you're not going to get that, but where, how does that competitive process help a borrower? Because I think people want to understand that, because if I give a deal to you guys or to whoever, if someone comes back with one term sheet you can't say they didn't do their job, because they'd be like, well, no, here's 18 people that turned it down. But what can a borrower expect when they bring a deal to you after you get through the underwriting, after you have the business plan set, you guys go to market? What happens next?
Right. So, I think best way to look at it is from a true capital markets perspective. Agency, you're going to get your Fannie bid and your Freddie bid, assuming both guys are willing to play in that market. And we're going to, you get Fannie saying, hey, what does Freddie look like on this deal? And, we do what we're supposed to do and try to make sure we get you the best deal. But that's, the kind of standard head-to-head competition you get on the agency side. On the capital market side, whether it's a stabilized deal or it's a bridge loan, we're never going to show you 10 term sheets. I think that's way too much information to deliver back to a client and have them to break down. We're going to go out, and again, every deal is different. There might be a deal where we go to 30 or 35 lenders, and there might be the deal where we go to 6. And I would probably say 6 is probably on a low end of a number in terms of lenders to go to, because as much as, we're on top of the market and we have a handle as to who's doing what, it could change, in a second.
Right.
So, platforms are changing. It's ever changing, which is another reason why, as a real estate acquisitions guy, you shouldn't be running your own debt because you're not in the space every day. There's no way for you to stay on top of it. Mm-hmm. But typically we're going to try to bring you, I would say, anywhere between 3 to 5 options on any given deal. We're going to weed out the ones that clearly make no sense. Now, if there's a side reason, whatever it might be, they're not taking as much upfront and they'll future, even though the other terms might not look as competitive, we're going to present it because maybe for some reason, this kind of backhanded way of structuring a deal makes more sense to you and your capital. That's not for us to decide. But if, someone's at 75% loan to cost at 350 over, and another guy's at 75% loan to cost at 300 over, and their terms are pretty much identical except for spread, I don't need to show you the 350 over. You're not going to want to pay 50 more basis points for nothing, right? So we're never going to show you 20 or 30 term sheets. That's never the goal. Too much information is bad information.
Well, yeah, because let's call a spade a spade. You give someone 20, what color shirt do you want? Or you give them 20 options. They look at you, dumbfounded, right? They're like, tell me about this lender. Tell me about this lender. Right now, maybe someone would want to pay 50 basis points more because it's like they're rock solid. They're not going to retrade you. But then you'd probably present that term sheet. So you're going to weed out, hey, this guy, he's got the best pricing, but he never closes.
I literally going through this right now. I have a deal I financed 2 years ago in Harlem, West 136th Street. Excellent client. We did a bank loan. He did a great job turning units. He's can't quite keep doing it now. But he's done a great job where we are right now. We presented him with 2 agency options, 3 bank options, and a CMBS option. And I told him right off the bat, I showed him one of the banking options. I said, I know it looks attractive. This is not a route we're going down. I said, the terms are too close for everything else being equal to go to a bank that we don't have confidence in that will close within his time frame as they put in the application without tremendous headache. So, and then, we talked through the rest of the options, what's most important to him. We had a credit union with no prepay as a strong option. We had a CMBS 10-year IO deal with defeasance if he just wants to put the thing to sleep and, cash flow for days and days. So, those are the kind of conversations that come place. We're going to bring the options, try to break them down as much as we can, figure out what ultimately is really most important to you, and then try to, obviously within that realm, make sure that we're going to a lender that we trust implicitly to get to the finish line.
For sure. What are some of the things from like the ownership side that we can do or another owner can do that's going to, either streamline the process, make it easier, get better
This
deals?
Is coming from Toro?
Yeah. I know it's a laundry list of things. It's a little self-serving, also let you vent a little bit. But, what are some things that you see over and over, whether it's over and over from us or over and over from all your clients that, maybe we just don't realize, or just things that if you did this, it would make our lives a lot easier and your life a lot easier? Speak to some of that a little bit.
Well, I know the best thing to do is change org charts at the last
minute. No, John's definitely got it. I think the most important thing between a broker and a client is communication.
Right.
I think it has to start with there. So, being available.
Mm-hmm.
I view my job, Ralph and myself, our job, a big portion of our job is just being available.
Right.
Being able to understand, comprehend, deliver whatever we need to back to whichever lender we're doing business with. But from the sponsorship side, lead time, when it comes to, I guess there's different steps. We want to start back where we're starting to look at a transaction, right? Every time you send me a deal, I'm going to ask you for the same
same
stuff,
shit.
same shit over and over. Okay. Over and over again. Right. So, be prepared.
Right.
If you're sending me a deal, have a pro forma done already.
Right.
If it's accessible, have a T12 broken down monthly. Get me a current rent roll.
Right.
Right. Basics. Allow me to go start, dig in, do my job, throw it into my own model, and give you the quick high level feedback that you want. Because typically you're calling me, you're like, hey, we just bid on this deal. We don't really know where it's going to shake out. The sales broker's telling us we have a pretty good inside track, right? Our top number is 20 million. So I'm typically going to always go out at whatever you tell me the top number is, because always easier to always easier to backpedal than to try to go up and stretch. So, right, having that first step, getting us what we need, and it's pretty much the same list on every deal, even if it's agency, especially on the multifamily side, whether it's agency or bridge. I want a pro forma, I want a T12, I want a rent roll, I want a CapEx budget. If we have one on a bridge, I'd love for it to be broken down. I'm assuming it's not going to happen right away. But I mean, the lead time items, once we get into process with a lender and we get there and we have a term sheet that we like, I mean, it's everything that takes time that we want to try to get out of the way right away. So John brought it up, org chart, right? Trying to finalize an org chart
operating agreements
early on in the process, having operating agreements. I've seen it. I've been fortunate or unfortunate to do many first deals for clients. and when a client doesn't have an operating agreement, I guess let's call it, that's form, right? To where, hey, investor, this is my operating agreement. We're not like negotiating every line here for you. And I've done deals where literally every single investor pretty much was just negotiating their own operating agreement, and it turns into a shitstorm.
Yeah.
I mean, it could be a disaster. So having that stuff lined up, doing some of the annoying paperwork that needs to be done, a lot of the know your customer stuff. If we have any kind of lockbox, even if it's springing, getting that open and on time. There's only so much we can do. Hey, can we get a springing lockbox to get pushed to a post-closing item? Yeah, most of the time we can.
What do you mean by lockbox?
Lockbox. So depending on the deal, asset type, whatever it might be, a lender wants the ability to sweep cash if the property is not performing to the level it was when it was underwritten. So if you're operating a multifamily property, we underwrote to a 125 debt service cover, and whatever it might be, could even be there was fire at the property and you lost 25 units, and now you're operating at a 110. Excuse me. The lender now wants the ability to sweep cash, make sure that you pay your mortgage, and then they want to sweep excess cash, basically as like a little protection for them, whether the loan ends up defaulting and they can pay the note down, or really just hold the money back, make sure you guys build up to where you need to be, and then you can always get out of that sweep. Let's say you hit a 120 for 2 consecutive quarters or 125 for 2 consecutive quarters. That money's yours. They're not taking the money from you. You can get it released once you bring that property back up to stabilization. So
it's basically a safe fall for the lender. If shit hits the fan or something goes wrong, and it's not a shit hit the fan, like you said, a fire, some issue happens, it's a lender's mechanism to say, oh, well, I'm definitely getting my money first, and without a problem,
and even a little bit of gravy, right? So again, if you're at a 110 debt service, you could pay your mortgage, and there's roughly 10% of excess cash flow, but they're not going to let you basically strip the property down, distribute that money to your investors while you're operating at a much tighter level than how the deal was originally underwritten.
Gotcha.
You definitely see it way more in office, industrial, retail, where you have large tenants, and then all of a sudden a large tenant goes belly up or files BK or gives notice to leave, especially like on the office retail side. They give notice to leave 6 months prior to the end of their lease expiration. They want to sweep that 6 months of cash prior to that tenant, because once the tenant's gone, there may not be excess cash.
Gotcha.
That's like
Yeah, I was
the
gonna
Home
say-
Depot you guys are doing for Don now.
Exactly.
They'll, basically, prior to expiration, they want to keep like 6 months up front, like before before the lease expires. They want to make sure they have money for all those reasons. So it multifamily,
Right.
you see it, but it's sort of like, just fill this out. This is not,
Right.
we're not underwriting.
Almost always in multifamily, you're going to get what they call a springing cash management, which means basically you don't need it in place at close. And if it's needed down the road, you have the paperwork filled out, but you haven't actually opened an account, gotten an account number. You shouldn't be paying fees, etc. On most typical commercial deals, you're actually, not always, many times you're opening an account, you're kind of putting it on the side. And if it's there for the lender to be able to sweep through.
All right. Makes sense. Yeah, I'd never heard of that before. So it's interesting. What are some of like what's the right word I'm looking for? Like things people often get wrong with like the debt world, or like assumptions that people make that you're like, no, it doesn't, it's not really that.
That's this
kind of touched on it, but like what are some of the misconceptions that you can easily like, hey, everybody expects, you can get 75% on a Freddie loan today, where you said, now it's debt service, it's not LTV constrained. Some things like that you've seen that people are just continuing to get wrong. And you have to correct all the time.
Right. So, I mean, people think agency lenders are 80% lenders.
Right.
Plus closing costs.
Right. Plus closing costs, right? I mean,
that was like 4 years ago. But you could get anything you want.
80 plus 3. And I think that's just generally a misconception. Agencies all market driven. So the markets are all tiered. We have our own internal tiers for Fannie, whether we're delegated on the underwriting side or not. And then Freddie's going to have their own criteria in each market as well.
Explain tiered.
Tier. So, there's actually two different tiers. There's tiers when it comes to the loan itself, 80 or 75% LTV, like sub 65% LTV, where maybe you can get, full term IO. And we've looked at a couple deals where I told John, I'm like, we can get to like 72.5 on a debt service cover. If we dial it back to 65, 135 debt cover, you can do a 10-year deal with 10 years IO. And now look at your
cash flow.
Your cash flow is significantly improved. You raise an extra 7.5% equity.
Yeah.
But tiers, you walk into New York City, if you could find a deal that's going to lever to 80 plus 3, you'll get it all day long, right?
Gotcha.
You're not going to find it, but you'll get it. We go out to some of the other more secondary or tertiary markets. We haven't done any agency for you guys out there, but we did a deal for you guys in Jackson, Mississippi. You're not going to get the same kind of LTV in Jackson, Mississippi, like you're going to get in a Tampa or in Orlando or New York City or in Miami or whatever it is. Reward. Exactly. So, you want to talk about cap rates and things like that and how people view deals. The lender looks at it the same way. How risk averse am I to the location, the asset quality, right? I mean, you show Fannie Mae 2010 build and a 1966 build in the same market, they're going to have a different outlook.
Yeah.
Right. So that's all a part of it. But there's tiers on the LTV lending side where you have caps on IO and debt service coverage restrictions. And then there's tiers when it comes to markets and, 1, 2, 3, 4, or however you're structuring it.
So is that a conversation like, we decide tomorrow we're like, we want to go buy in Boise, Idaho. Is that a conversation I'd come to you and say, hey, we want to buy 70s, 80s built stuff in Boise, Idaho. What does our agency stuff look like? That's probably something I should call you first before I go put a deal under contract, right?
Yeah, absolutely. So, again, we'll tell you best case scenario.
Yeah.
This is what it looks like. And, 2 out of the last 3 deals that we did in this market that looked exactly like what you're describing, we only got 70. So that's absolutely a conversation. If you told me you were going to the bridge world, I'd tell you that the criteria is not as tight. But certainly in the agency world, yeah, I mean, we'll tell you best case and likely worst case, this is what it looks like. So hopefully you land somewhere towards the top of that.
Yeah.
So sure. I always tell people, you got to bring the right team member in earlier rather than later. You can't put a deal under contract and have no idea what the debt looks like, have no idea what your equity looks like. And then the deal's under contract and you need 85% agency debt in, Tuscaloosa, Alabama. Like that's never going to work. Right. So, as Jeremy said, if you're a guy that buys or a girl, if you're someone that buys in Florida and now you're going to buy in Nebraska, you can't be offering on properties before having a conversation with the team, because they're going to say, guys, it's a little different, right? You're not in South Beach, Miami. You're in, somewhere else. So understanding that early on, you guys don't want to be brought in, oh, we're closing in 15 days. What can you do for me, right? That's not a good, not that you can't do it, but that's not the preferred situation.
Listen, if you want, 10 and 2, we could probably get it done in 15 days. But clearly not. And that's why one of the first things I said is communication between, broker and client is super important. And when we get paid when a deal closes, and I say this all the time, we're not just getting paid for that transaction. We're getting paid on all the other deals that you called me about, and we gave you high level feedback, and we sized up, and we ran the numbers. We might have even gotten you term sheets. You got outbid. You went under PSA. You did some due diligence. You pulled the plug. Right? I mean, this happens in our world every day.
We're paying back all the $2 bills.
Exactly.
But on the lending side, people don't realize that. They think it's transaction based, but it's easy for someone else to throw in your face and say, well, you bailed on 18 deals in the last 6 months and we underwrote all those. So you have to understand that. And it's not only that, we have deals daily. I called Jeremy yesterday and I was like, we got to, how do you want me to handle this with the lender? We have to move some money around, and, we're under budget on wiring, and we're, our flooring is a little bit more expensive. So, it's not, deals over, wash their hands, goodbye. They're hanging with you throughout, and they're going to do their best. And you have an issue, it's okay, let me make a call too, because you got to use that relationship to the best you can. So it's not just a per deal transaction. There's a lot that goes into it. I mean, as I started this out by, Ralph, 7 years, 6 years. The first loan we did was a couple of years ago. So it wasn't, it's a long-term, and we beat him up on price also. So, but no, it's a long game. Any real estate deal you do, if you're getting into real estate, you're looking for quick money, you're probably in the wrong business. So it's a long game, and you got to bring the people in early on and find the right person early on, because that's how you're going to build your business successfully.
Well, I think any client services business, you don't pay for somebody's time, you pay for the value they bring. I think that's a big misconception when you start working for somebody that's providing you a service. Same thing with, our investors or clients. Nobody uses that word, but it's the same thing. You're not paying for the deal you do, you're paying for everything that went into getting up to that point in time. So at the end of the day, if they're bringing you enough value, what is that worth?
Correct.
Maybe it's not, I've never calculated the time you spend per deal and what you get paid, but there's plenty of deals you look at that you don't get paid on. I'm sure there's plenty of hours that are ancillary and wouldn't be calculated towards it. So I think that's a big misconception in any client services. It's not we're paying 1% for this deal. It's everything that's gone into it and everything that's led up to their ability to get you that deal today.
Correct.
Great story to jump on that.
Go.
And it's actually happened twice in the last year. Recently, one of my colleagues had a client reach out directly to a lender they had a relationship with, and they got a term sheet on a deal. It was a smaller deal. They got offered $7 million on a bridge loan at, 325 over. And my colleague went out pretty much to the rest of the market and was having a difficult time getting really solid traction on the deal. And we knew, and I said to them pretty much early on, they brought me kind of up to speed on what was going on. I knew that the right lender for the deal had already quoted it to them direct, but it was a shit offer. And they definitely could have gotten there. And we basically said to the client, like, listen, we have an excellent relationship with this group. You went to them directly. You went to the wrong originator. Your underwriting that you sent to them was a mess, because when you sent us your underwriting, we had to like rework your entire pro forma to get it to have it make sense on an exit from a lender perspective. And we ended up they allowed us to go back and approach the lender, and we got an extra $1 million, and we brought their spread down to 300 over from 325. So it's not necessarily even always just the relationship. It's not just the amount of time. Like you said, there's the value brought to the table, right? That what's that really worth?
Right.
And then being able to work even with this literally the same lending group and get a completely different bid by the relationship, the volume, and showing them, hey, you need to forget, what you had to look at. Those are not the numbers. You need to look here. And that allowed us to get what we needed.
Well, so that's a common misunderstanding, is that the investor pro forma, the pro forma you put together internally, is different than the pro forma you send to your investors. And it's also way different than the pro forma you send to the bank. Not saying that you're trying to deceit and lie, but you may know your deal costs $1,200 repairs and maintenance using that number again, but you might have turns in there where you guys can show $900. And you're renovating, you're spending $4 million. It's like, well, you're going to have no turn exposure because you're spending $12,000 a door. You don't portray that up front early. You just took your millions of dollars out of your pocket and rate increase, because now they're like, why is it $1,200? And the lender's not going to correct you and say, oh no, you could lower this and we're going to give you more money for cheaper. That's never going to happen. So, you're not doing anything wrong. But that's the job of a broker. That's their job. It's say, hey, here's my pro forma. Let's make the change, because you realize you're spending $5 million in capital.
Debt pro forma, equity pro forma.
It's different.
Yeah.
I'm sure too, it's because I know when I was drawing parallels between like, why would you use a broker to sell a property? And I'm sure when you go to a CMBS, bridge, bank, credit union, they've all got different ways they look at deals and they've got certain expectations. So when you present the deal, I mean, I'm not going to present it necessarily the same or have the same conversation whether I go to an agency or a bridge lender, because they have different expectations, different exit, different things they want to see, right?
Yeah, I'll go back to this deal in the city that we're working on right now. CMBS doesn't necessarily care to see a broken down T12. Banks don't necessarily care to see a broken down T12. Agencies have to see it, right? So immediately they're gonna take a different look. Banks are gonna rely much less on historicals when they're looking at the financials of a building, and they're gonna go much more based on their knowledge of the immediate market and how they think the property would operate kind of independently, literally just how their internal numbers show. And that could be their servicing portfolio, could just be their generic underwriting, however it is they size. So yeah, I mean, our models that we send to lenders will vary based on who the deal is going to, right? And I would even say, even within the bridge lending spectrum, there's some lenders that look at a deal and they take a total cost structure and they say, I'll give you 75 or 80% of total cost. There's some lenders who want to break it out. I'll give you X percent of acquisition. I'll give you X percent of your CapEx. I don't count closing costs as part of a transaction. So even within the world, there could be little subtleties between different lenders, and that can tweak. And different lenders have different requirements. Some bridge lenders, if I don't have a 5 debt yield going in, I'm not a player.
Right.
So different ways of trying to make sure that you hit a hurdle. And again, not trying to deceive anyone, but show the numbers in a way that are based on actualities, and say, hey, we closed today. This is my rent roll. This is my gross income. This is my new payroll schedule. And that's something that we've done on many deals. John, I've got your payroll number. Show me what your schedule is going to look like. How many employees are there? What are they getting paid? Who's full-time? Who's part-time? Break it out for me. So these are a lot of the conversations that go on, and there's different nuances between different lenders, even within the same field.
Yeah, I mean, we shot ourselves in the foot on a deal you guys financed in Alabama.
Oh, yes.
My partner sent the wrong model to the bank, and it had a mistake, and they cut our proceeds by...
It was right. Our rent roll did not account for concessions.
Yeah.
And it wasn't labeled anywhere. And unfortunately, our projected rents dropped because we had ongoing concessions, which then led to our exit looking different, which cut our proceeds.
Yeah, and it was a mistake. They probably, it was a mistake. They would have found out eventually. It was better they found out. It would have been better if they found out later on, because they might have missed it. But that's what happens when someone gets involved that's not paying attention, or a bank says, hey, give me a rent roll, using them as a buffer between the two. This is something that could be sent. Maybe they missed it too, or maybe you missed it too. Maybe it would have been just a mistake across the board, but another set of eyes bringing the right thing to the right person. That doesn't happen, because those reoccurring go away in 3 months, 6 months, 12 months. So it's not that bad, but the lender looks at it as like, nope, T12, can't take $3 million off the purchase. So it hurt. It pissed off our equity partner, and it pissed off my partner, but he blamed, people make mistakes, but that's the mistake of going directly to and not
right.
help.
So, I mean, as you guys know, I'm always completely in favor of dialogue between lender and borrower. I think keeping up a true iron curtain is not a benefit. I think it's important for the lender to know and be comfortable with the sponsorship. At the same time, when it comes to specific diligence items, I want to see that. I want to see that first. It's important just to have another set of eyes. It might not necessarily change anything, right? But at least okay, listen, if we're gonna send this to them, these are the potential fallouts. How do we want to handle it? Let's have a game plan before we.
Correct.
We don't want to be blindsided by it. Like we were blindsided by it. I remember they made like a quick request for an updated rent roll, and we just shot it over, right? And it cost us.
Yeah.
And that happens.
Yeah. I'm sure it's even little things too, like certain groups like things presented one way, or like they might like batches of information, or they may like weekly calls. And if you're going direct to somebody, it may just irk them slightly wrongly over throughout the relationship if you don't, fit into their process. I'm sure there's little nuances between every group that comes up that you got to navigate as well. And if you don't know it, or you're not in it every day, probably makes a big difference, especially over the long term.
Yeah, every lender, just like every person, has their own little way of doing things, and it may not be your originator at the lender. It might be their analyst or whoever is kind of collecting the diligence and putting together checklists. Everybody has their own way. Some people will say, don't just give me one due diligence dump all at once. I'd rather let's start with, the important things we need to get out of the way, KYC and searches and all that other kind of stuff, and then get me operating. I would say most people fairly lax. They'll take it and they'll digest the information as they see needed.
Yeah.
But definitely, some groups and different lender types have different way of digesting information and how to give it to them and when to give it to them and what's important and, what they want up front as opposed to down the road.
For sure. Want to segue a little bit. You guys have obviously been in it for several years. How has the debt world changed over the last couple of years? What is changing now? Obviously everyone's talking about market cycle and things like that. What do you see with the debt world in regards to the market cycle? Any effects? However you want to take the 5 questions I just threw at you, feel free.
We've seen rates even in the last 2 years really cycle up from even, north of, and let's just talk fixed rate for a second, north of 5% for quite some time to, I just got a quote again on a local bank deal at sub 3% on 7-year money on a swap, right? Crazy free money. So we've definitely seen changes. Obviously with what we've seen with, what's looked like a growing economy, and then we've had lots of Fed movement on short-term interest rates, which is, just another misconception in general. Well, the Fed's lowered rates 25 basis points. So, yesterday my rate was 4.25%. Now it's 4%. No, that was LIBOR. That's short-term interest rates, not long-term, 7, 10, 12-year money, which are typically based off a treasury or a swap rate. So we've kind of seen many cycles in terms of rates, even within this current cycle, which we can call, 2011-ish through the present. We've seen a big change. Just go through, let's say, the different lending aspects here, right? CMBS risk retention came into play a couple of years ago. That was a massive scare for many lenders. Now the originating lender needs to keep some of the risk, where in the past they were literally it was sell the entire aspect of the deal and not retain any risk. And obviously this was to try to rein in credit standards and have people kind of tighten up. CMBS 1.0 pre-crash, you didn't have any of that, and you had lending standards get really lax.
Hence the reason what happened.
Exactly.
Just so I understand, basically you're saying CMBS is they put together a deal, then they securitize it and sell it off
in massive pools.
Yeah, in pools. This now they're saying you can only sell off a certain percentage, and whoever puts it together has to hold a percentage, so they don't go. Correct. You can have 90% at a
right. So they there's a few different ways of risk retention, vertical, L-shaped, as in terms of how they view or what exact piece and exactly how much they need to keep. But there are rules and restrictions in place in terms of what they need to do. And we haven't seen CMBS has not gone back to 80% on a senior first mortgage. You're not seeing 75% LTV deals at 10 years IO unless there's mezz built in where, your senior is really at 65 or whatever. So a lot of the things that went on in CMBS 1.0 we're not seeing now. Hopefully that's a good thing for all of us, right? As we continue to go through the cycle.
Right.
It's got to make you feel a little bit better than just shit happening that you look at and you're like, wait a second, that one looks a little awkward.
Yeah, exactly. So I think the CMBS side, very healthy right now. Guys are actively looking for business. Pricing is extremely aggressive.
It sort of went away for a little bit, right?
CMBS went away, I think it was the end of 2016, beginning of 2017 when risk retention really came in.
Yeah.
No one really knew what was going to happen. And originations just kind of literally came to a screeching halt for quite some time until people slowly started figuring it out. And then it was bam, 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 bam.
I mean, that's when I came into it was 2016. And I've only really just started hearing more people, exploring CMBS in the last 6 to 12 months.
Well, you've seen it now because the agencies disappeared for a few months this year.
That's part of it as well. It
Correct.
was,
right.
For 3 months, everyone was like, you can't really get agency debt anymore.
I mean, you could have 5%, right?
Yeah.
So they were pricing themselves out of the market.
And then it was like, I guess we're going back to CMBS. So it's interesting to hear that.
Yeah. So, I mean, right. Agencies this year, just as an example of lenders kind of going through ups and downs, right, were a combination of pushing up against their lending limit caps for the year as to kind of what they had set aside, as well as feeling that with how low the treasury had gone, rates were... I mean, we closed several agency deals at sub 3% money.
Yeah, that's insane.
That's insane. We were doing a ton of deals in the low threes with a bunch of IO. I mean, it was very, very aggressive. It was taking mediocre deals, and great debt makes mediocre deals, right?
Yeah.
Great deals, at least from the cash flow perspective, doesn't make the deal great, right? And that's another misconception. People, if your debt is making your deal great, that's a problem.
Yeah.
But it could certainly help make it better. So we saw agencies literally disappear for a few months this year. They didn't say we're not lending, but when you come out and a market interest rate is 3 3/4 or 4%, and you're quoting deals at 4.5 and 4 3/4 at lower leverage, you're not really trying. You're not really trying to do business. I had a client who took the brunt of it. We quoted him a deal, Freddie Mac loan, 75%, 125 debt cover. He had a little issue with the seller, and came back to us 2 weeks later when the Freddie Mac loan app had already expired, and we went back to Freddie and have them refresh, and they came back at 65% with no IO and basically blew up the deal. And that was right when they had pretty much pulled in the reins.
Yeah.
So that was the first time I had, as an agency lender, Walker and Dunlop, I had ever seen anything like that. And my guys inside who have been doing this for way longer than I have had never seen anything like this either. So it was definitely a very unique situation. And CMBS picked up more multifamily in that 4-6 month window this year than they ever dreamt they would get. And that's a massive win in CMBS land because they normally don't get nearly as much of that business.
Yeah. I mean, we were shocked. Who was it? I'm trying to remember. Somebody I remember they were looking for agency and it just basically fell out and they were forced to go CMBS. But I mean, I was shocked at, the rates and the leverage that was getting quoted out there. I was like, it's like going to work in your pajamas and being on your phone the whole time. Yeah, you're there, but are you really doing anything?
Well, yeah, because rates were falling. The treasuries were down, everything was down, and all the agencies did was just like widen their spreads, right? It's like how they price things is based on the spread over whatever the instrument is, whether it's a treasury, a LIBOR, yeah. So they just widen their spreads. So, I had people call me, they're like, "Oh, your rates must be great." I'm like, "No, the spread's ridiculous. It's crazy. It doesn't make sense." And those are things like through this up cycle, the debt world's not really gone. It hasn't matched. I mean, the debt's been ridiculous. You've been able to get almost, it's been crazy. But the internal debt world, it's changed. And if you were always, I'm going to go buy 10-year money, 10-year money, 10-year money. And that was what your strategy was. There was a period of time where you probably either fucked your deals up because you weren't using other products, or you just bailed and you're like, I'm not buying deals right now. And so that's the other important part, of having someone in the space day in and day out. They can bring to you a CMBS product and say, no, look, you were going to put 10 your money on it.
Here's another
option.
Right, there's another option. Again, CMBS, right? There's no supplemental, which is a key component in a lot of multifamily operators, right? They want the ability down the road to come back and recapitalize their deal without taking interest rate risk down the road. So, you grow your NOI and you come back and you want to, you don't just want to live off the cash flow. You want to return capital to investors. Investors like bigger checks, returning their equity rather than just clipping a coupon, on their returns. So that's definitely a big part of it. But to go back to your original 4 or 5 questions, the bridge space is, I think, really where we've seen in this cycle the biggest transformation, where early on, 2012, 2013, LIBOR was 25 basis points. Let's start with that. And no one ever thought LIBOR could move. It was at 20 basis points, between 18 and 24 basis points for years, right? And we were doing bridge loans at 70, 75% loan to cost at 425 or 450 over LIBOR. And your rolling coupon was still, pretty attractive. Deals were even getting done in the 500s and 600s from what you would call now more conventional bridge lenders, but maybe it looked more like what I call soft hard money, even though obviously that makes no sense. But there's now layers to bridge. There's, guys doing bridge with a 2-handle. You can go to banks that are going to do bridge with some recourse with a 1-handle. Ralph and I did a great loan on
when you say 1 and 2 handle, what do you mean?
It's 175.
The spread. So like in the 100s, in the 200s.
Yeah, 175 over LIBOR. So Ralph and I did a great deal locally for us in Mahwah, New Jersey, on like an industrial flex deal. We did a deal with a bank. We closed at 185 over on, I think it was 70% LTV with an ability to earn out. There was recourse with a burn off. So there's a lot of different ways to structure bridge. Most of our clients prefer to stay away from recourse in general. And then you're going to your more conventional type. But even there's guys who can price deals. You go to life companies at slightly lower levels, and they'll give you a low 200 spread over 250 on a high end. And then, you go to some of the more aggressive debt funds and you can get low to mid 80s loan to cost in the high 2s, 3s. And then obviously you have more expensive guys doing deals in the 400 or 500 over range. But the bridge money is really transformed.
Because I even know when I started, it was at the time when like recourse was it was early on. So there was a recourse component. Banks, I think the first deal I did was like 70% LTV, 5.25 fixed. It was bridge because it was a disaster property. But like that, that today you're not. That product is not, I don't know if it's out there. It was a bank, but it was 100% recourse. 100% recourse today, you've seen 5.25. 100% recourse, you're at like 2 to 2.5. Because I mean, even the deals we have now, we have no non-recourse, 100% future funded CapEx, 285 over LIBOR, and LIBOR just, it's like falling off a cliff. Yeah. It's, it was 185 maybe 3 months ago. It's at 170, maybe even lower today. But
yeah, so I mean, it's putting your rates somewhat competitively against agents.
Yeah, our bridge rates today. Like we just got a letter in the mail on Hartford. We got a letter that our rates lowered because the whatever the spread
right.
LIBOR's down. So it was like last month, and it's calculated on the first of every month if it's a floating rate loan. So last month it was like 4.6 and now it's like 4.4. And I was like, oh, look. Well, picked up some money.
Right. It's interesting. And I think I mentioned this. The first time I ever negotiated a floor for LIBOR was on River City, where we're in an environment where LIBOR now is clearly made a move coming down with 2 Fed rate movements downwards with potential movement going further. And we've only seen LIBOR from 20 basis points incrementally go up. The Feds meet, okay, 25 bips, 25 bips, 25 bips. And also one thing people don't realize is typically LIBOR actually is already adjusting for the next change before you actually get there. So when the Fed makes their announcement, that's already been implemented
prior to
into the short-term rate, 90%, 95% chance the Feds are going to raise rates today. That's already been building in over the last couple of months. But, we took advantage of the opportunity with a falling LIBOR to push. And again, not every bridge lender will give you a lower floor on LIBOR to get there. But it was something I did for the first time. And and it's nice when it pays off.
It does. So from that, we negotiated on this, and we're doing an assumption that Hunt had the debt. So Hunt's doing all 3 deals. So they actually got very competitive. They actually gave us a LIBOR floor, 285 over, and they had the LIBOR floor, but they actually put in there, it's the lower of LIBOR at application or LIBOR at closing. So let's say, LIBOR at the application is 175 and it goes to 3, our floor is 175. If LIBOR is at 175 at application, it drops to 1.3, it's 1.3. Now, if it goes from 1.3 down after closing, you're shit out of luck. Right. But that was something that if you put that, 6 months ago, a lender would be like, get the fuck out of here. This is LIBOR, here you're at. But now that's a competitive switch they've made. They beat out Arbor. They beat out a ton of other lenders, and it was a very, very compelling, very compelling.
Yeah, listen,
loan.
That's become a negotiating point where in the past it wasn't even a conversation because it wasn't in anyone's mind. What happens if LIBOR goes down? It just that wasn't the trend. I mean, we've gone from 20. We must have been through 10 or 12 rate hikes in the last 3.5 years. No one kind of saw it. And now a small correction, try to boost the economy a little bit, or whatever their mentality and thought process goes into it. So it's just become another kind of spot to negotiate and have discussions with lenders.
Yeah. Well, at one point in time when all those hikes were going on, we thought it would be a decent strategy. Thank God we didn't do it. Do all our deals 10-year money, sell them as loan assumptions with lower interest rates in the future. Thank God we didn't do that.
No, we have a deal. We're going to market now, and there's no supplemental. The rate's like 4.6 or 4.5. It's a very challenging deal because that deal was 3 years ago. 3 years ago, who thought rates were going down? It wasn't.
No, it's crazy.
It's crazy, but like you said, at that time, it's like 10-year money rates will go up. You'll have a 4, and it'll go to 5, and you'll be able to sell that deal for a massive premium. We were wrong. I mean, 100% wrong.
I mean, I can tell you, I've had those exact conversations now where we're looking at, high 3s or 4% long-term fixed rate money. And I say to the client, I'm like, listen, the likelihood that the loan is an asset is way higher than it hurting you down the road in terms of strictly pricing. If values keep going up and cap rates continue to tighten, might you be lower leverage than where a buyer potentially wants to be? Definitely possible. But I mean, like John said, I mean, who saw this coming? I mean, I wouldn't believe anyone who told me that they did.
That's like even our rate cap. They're allowing us on our rate cap to do one rate cap for all 3 deals. So it's one rate cap purchase. So you're going to get, it's like anything else, economies of scale. We're getting value, one fee
for all 3.
Not the assumption because it's fixed, but the other 2 deals, they're doing one rate cap. Now the risk on our side is if one of the deals falls apart during contract or the loan, because then you overpaid for your rate cap. But the rate caps are actually so cheap. They're actually assets.
Yeah.
Because that's what we said on the call when we were talking to them. Like, well, if we buy one rate cap, it's so cheap. If the world goes the other way, that rate cap's going to be worth money. So the risk you take is, okay, one deal falls apart, you paid a little bit too much, but at the same time, that little too much. A year ago, those rate caps were 3 times the price.
Yeah.
We closed Townhill. I think your rate cap cost like $150,000.
Yeah, another $15,000,
right.
$18,000.
And now you're buying a much tighter rate cap, and it could be on larger deals, and it's $10,000 to $15,000.
Yeah, it's crazy.
Yeah. So just real quick, rate cap is just you purchase a cap, can't go higher. So if you have a floating rate loan, your rate's never going to go to 7. Question though, do you have anybody that's stop considering rate caps despite the price, but considering what's happened with rates? Is there anybody that's going
lenders who have not required it in the past still don't require it? Lenders who are requiring it are still requiring it and saying like it's so cheap. I mean, right? It's
that's how I look at it.
It's very cheap insurance.
What about on the client side, like the sponsor owner side?
So the only thing, I mean, Don happens to really love to dig into the weeds on the rate cap. Maybe we should, go even tighter and really, tighten this thing up and make sure there's no wiggle room and we don't put ourselves in position. I would say up until where it's come so cheap, most sponsors wanted as wide of a cap to save themselves on the cost because it was
expensive.
Money. It was real money. Now it's the cost in general compared to the deal is so minimal. It's just, this is what they want. Okay.
So, because I've am not as involved on the debt side as them too because they're on the loan.
Right.
The rate cap is a third party company.
Yes.
That's almost like an insurance, basically, correct?
Exactly.
It's
exactly what it is.
rate hike insurance.
Yeah. So it's there for both you and the lender, right? I mean,
Right.
you want to be protected to make sure your rate doesn't go through the roof.
Mhm.
The lender wants to be protected to make sure your rate doesn't go through the roof so you can service your debt. Sure, it brings them a nicer return, but ultimately if you're not paying your mortgage, that's
Yeah.
way bigger.
Yeah.
It's way bigger of a problem.
Way worse
Rather-
return when they have to
rather get paid
foreclose.
slightly
Exactly.
less,
And
yeah.
listen, there are definitely loan to own guys out there, not on the kind of deals, that we've done together or
Mhm.
most deals that we get involved in. Really, way more than most.
You should have seen the pref structure that we
I was
just got.
just going to go there. When
We
you
got offered a pref structure. It's a group that I've been talking to for 5 years. They put a pref structure out there. They wanted 100% sweep of cash flow. I was like, guys, I'm not trying to be an asshole, but you're actually giving the money to people like this. Who the fuck is signing this? Because it's like they wanted a 16 and they would give you pari passu over 14, or 100% to 14 went to them. So every single nickel out of cash flow went to them to 14. So I was like, you're 100% betting on the sale of the property. You're not. You want to throw sponsors out, take their money, and take over the property. They're a huge group.
Sounds like you've spent many years of wasteful conversations.
Well, so they raised. There was like $1 billion that they had to place, and they were like underwriting to 8.5 and 9 caps. So like, oh, you're never going to place equity.
8.5 and 9.
So then they turned that into, we'll do pref at 6 to 7%. It's like, oh, let's continue the conversations.
Right.
That 6 to 7% pref, they just quoted us on a deal. And I was like, guys, this is criminal. Like, I should report you because you're giving people a lot of money. Like they'll give you $25 million in a tranche that you could spend, over 18 months.
And just go spend it.
Spend it.
Deal oversight?
So deal oversight up front. The tranche has got a criteria, based on what you look for.
Right.
But then you could just go chip away. Like you send them the deal that go, just clip off $25 million in pref at 14%. I'm like, but 5 years ago would have been the best thing ever because you could have flipped out of those deals for 30 and 40 IRRs and you would have made a ton of money. Today, 14, I mean,
It's a big number.
that's huge. I said,
number.
they just disguised it. And I'm like, you guys are looking for idiots. And they are.
We know a group, I don't want to say, but they had a $1 billion group invest with them, and they're just ousted out of a deal in Denver. Similar, these
Is the group that threw the sponsor out of Denver?
yeah,
We're probably
invested in it together, but it's a huge reputable group that's a big pref lender.
Where are they out of? Where is the group out of?
South.
Okay, this group's out of Denver.
Oh,
They have one office in Denver. That might have given them away, but it's fucking brutal. He said it. His back was turned. I said yes. We're talking about this. I saw the prep. I saw it. I was shocked.
break down the structure a little bit more because we're gonna have people that have no idea about pref equity, let alone pari passu
So-
in a little bit, so people can follow.
Pref equity is you have a first position loan
Yeah.
that is
So your bridge loan,
your
your
bridge
agency
loan,
loan.
your agency loan, and they'll put up 60, 70, 80% of the debt.
Right.
A mezz or a pref is a second position that's not tied to the first position.
Right.
So I'll give you 65%. Ralph gives you 10% of the equity or 10% of the difference.
Yeah.
And then you bring the rest of the
So
money
if the
to the
whole
table.
deal costs $10 million, they'll do 6.5 in debt.
In
then
debt.
another $1 million in
Yeah.
pref equity.
That
or
million
mezz
is
debt.
pref.
Right.
That million, people want 100% of cash. They wanted everything. I was blown away. And I entertained it for a while. And then he sent me a term sheet because he was explaining it. He was explaining it in a way that I was like, 6% money. That's yeah. He sent me a term sheet and I called him. I'm like, you have a 1 in there. You have an extra 1. I thought it was 6. He's like, oh no, 100% to 16. Sweep. I was like, no.
Yeah. And the reason, again, just it's unattractive is because a lot of pref equity,
It's a lend
they'll
to
split
own.
cash flow up to a
And
certain
it'll
percent.
accrue.
Yeah. And
Yeah.
they'll basically their first money out, but your other equity gets a higher return basically.
Correct.
Because they might end at 16 and you keep everything over 16. So if
Correct.
you return a 25, you make the spread on it the same way you make the spread on debt for regular equity.
Exactly.
But the problem with this is because they want 100% of cash flow, the other 30% of the money, so $3 million in regular equity, gets no cash flow until the deal
they're
sells.
sitting on
And
the
you're
side.
just banking on, all right, if we make a 25, my 25 turns into a 30 because they're stopped at 16. So it's you got to be super fucking bullish on a deal or super, non-risk averse to even contemplate a structure.
Correct.
Like
yeah, you have to be super bullish.
A normal pref, they'll split cash flow.
Yeah,
so
they'll split it. There's flexibility. Yeah. This, you have to be so bullish on the future of the real estate market that it would only make sense if you knew something that no one knew, like no more building ever. And this is it with this, even that I wouldn't take it. But, they're giving money hoping to, it's predatory, that structure to me. I just think it's absolutely insane.
Where Jeremy said loan to own, it's, you're almost sitting there thinking, okay, do these guys actually believe in the deal? Or do they believe that, hey, I can go up to 85% of the total cost because I know you're not going to return what I'm putting on paper. So in 2 years when you're, underwater, I'm going to take over the property. You may or may not lose your money, and I'm going to own it for 85 cents on what you bought it. And that's where the loan to own, pref equity, regular debt, whatever it is, that's kind of, that's the fear you got to have in mind when you start talking about pref equity, mezz debt and stuff. It's, are they, is it kind
are
of
they
like
giving you the money in their best interest? Is it the best interest of you, or is it the best interest of them?
Yeah.
Yeah. It's, you like Chris mentioned, now all of a sudden the rest of your investors have taken an absolute backseat to everyone else. And how do you explain to your other investors, well, guys, we're going to take a 10% pref, a 20% pref guy here, and they're just going to suck every ounce of your money up until we hit a giant home run. And then maybe we'll see a little bit of leakage. And then maybe one day we'll hit a real home run and exit out with a capital event. It sounds like a very difficult
if it's I told the guy, I said, if it was my own money, go for it. I'd risk it. Maybe. But I wouldn't, but I'd be more inclined to. If it was your money, I'd definitely risk it. No, if it was,
don't rely on my money.
If it was investors' money, how am I supposed to take that with investors in a deal? It's not possible. It's so much easier for the market to recess 15%, to lose all your money when they lend it up to 85%, than it is to go north of 16% year after, 2 years, you got to sell it for a 32% return.
Yeah.
They break even, you get nothing.
Yeah.
Like you break even, they make 32%. It just, I do believe that okay, we're going to pull the wool over our eyes, because there are a ton of groups out there that are fee driven and they don't care. They'll go buy deals left and right and clip this off because, we only have to raise $1 million.
Yeah.
We'll figure it out in the future.
Do you ever work with somebody, because probably mostly on the bridge side, that you get the feeling that, hey, these guys are lending on this because they think they can get it for, 85 cents in the dollar in 3 years, or that doesn't really happen? Because I see some bridge terms, I'm like, how? Like, that's so aggressive. Like, it's 80% of cost, and you look at their all-in cost, and you're like, that's like the highest thing in the market. There's a 2,000-something bill deal we saw from another sponsor. We're like, that's ridiculous.
Not going to work.
We're like, we spoke to an investor, and I was like, if you expect to make what he put on paper, you're kidding yourself. And whether he, really believed it or not, he expected to make half just in his area, so he was okay with it. But do you ever get the feeling that somebody's lending for that purpose, or not really?
Any of what I'd call the traditional bridge lenders, the guys who we've done business with, the guys playing anywhere from 200 to even 500 over LIBOR in today's market, they want nothing to do with owning your asset.
Right.
That's literally the last thing on their mind. It costs too much money for them to go through the process and then take over and figure out operations. I think really the only time you start to see loan to own, or when you get to kind of double digit money looking to take advantage of a sponsor who's in a situation. Could be for a multitude of reasons. Could be property level, could be personal, could be a family situation.
Yeah.
Could be all sorts of different reasons where you get the feeling that they're putting them in a loan to fail. Mm-hmm. And listen, a lot of those kinds of loans, they're kind of set up to fail without something happening or a sponsor turning themselves around. It's really just more of buying time for someone to get their act together, whether it's, again, property level or family, to put it together. You really don't see it. Even 10 and 2 guys, most of them own assets. And if they wanted to buy your property, they probably would have figured out
what are 10 and 2 guys?
Had it 10% on the rate and 2 points.
Gotcha.
So,
okay.
Your typical hard money guy in today's world is going to be 9 to 12. I mean, to 16, 18%. We've seen it all with a bunch of fees, and they're going to have no out-of-pocket costs, and they're typically not even going to crazy leverage. Another misconception. Oh, hard money guys, they'll give me 95% financing. No, they won't.
Yeah.
They'll give you 65%. They're all about basis.
Yeah.
Because
when the world blows up, they're going to do really well.
Exactly.
And they want you to do well. They don't want the property for the most part.
They don't. I would say the loan to own guys are really very far and few between.
Yeah. Because the amount of foreclosures is so low. You're setting yourself up to take a property and operate it, basically wasting your time, because you've got to have an operator in place to take over and do it. And you've also got to have a debt placing platform in place. You're trying to operate two businesses at the same time. Better off just launching an operating arm and going and buying deals than doing debt to operate in the future. You might as well launch the debt side, launch the operating side, go buy deals, go lend on deals.
A loan to own guy today is like 2007. It's like the movie The Big Short. It's basically, I'm going to bet on loss for the next 3 years, and then all these people are going to fail. I'm going to take back everything, and I'm just going to ride the market. I'm going to be a trillionaire by failing for the next 3 years. That's the person it would take. Someone that's taking a gamble on massive failure.
Right. I think a lot of what you see now is people who have a little bit of that outlook. They're like stockpiling cash and just waiting for opportunity. But what's interesting, Chris, on your point, we've actually seen a lot of owner-operators turn into debt. Especially as the cycle's kind of matured. They say, well, I can go buy a deal and, have my equity be the last 25, 35% of the deal, or I can go lend on a deal and be capped at 65 or 70% of the deal, and I could make the same or an even better return. Let me go try to play in that space. Again, it's a completely different beast, but they don't need the same kind of market share like a big, a JP Morgan or any of these other large groups might need. So they say, okay, if I can pick off $100 million in debt a year, maybe that cost them $25 million in equity. They levered their money and then put that levered money onto your levered asset. And now their basis in a deal is topped out at 65 or 70, getting, anywhere between 10 to 14% IRR or whatever. Very low risk.
You lost me as you were talking. So how the hell do you turn 25 million into 100 million in debt?
Leverage.
They leverage.
So you
borrow money to then go lend money.
Oh, yeah. Most lenders leverage
It's
money.
not their money. They leverage it.
Yeah.
See, I'm totally... that's
So
I don't even understand.
So like I've been pitched over the last 4 months. I have a meeting next week with a guy that I'm suing. He doesn't know I'm suing yet, and this isn't going to be out after the fact.
You have like 2.5 weeks to move.
Yeah, so he's going to be sued on Tuesday, and I'm going to serve him, or someone's coming with me to serve him. But he wants to start a hard money platform. Meanwhile, he owes money to people. So I was like, okay, yeah, let's meet. And I know he has assets, so good luck. But I've been pitched over the last 6 months, hard money. Like, let's do hard money. Let's start a hard money business. And I'm like, and their pitch is, well, we only need $3 million, and then we can go take that and sell it, and we can get a spread. We can get like 2 points. We could borrow money at 2%, and then we're going to lend it at 8%. So they're leveraging a smaller amount of money to get a larger amount of money.
Just like you do when you raise an equity fund.
Yep.
Right. And you go raise $100 million of equity. You're capable now of, let's say, going to buy $400 million worth of assets. Right. So if I'm a lending shop and I have $100 million, I'm not just going to lend that $100 million. I'm going to go get a line of credit from a B of A or a Morgan Stanley or any of these other banks. I'm going to leverage my equity, take that money, and again, kind of like what John said, I might be borrowing it at 150 over LIBOR or something, really super cheap, and I'm going to have requirements from that lending institution. But now all of a sudden I've quadrupled my money and my capacity and what I can do, and now I'm putting that money out. So most lenders are leveraging their funds to put out.
So is that I did not realize. So like any bridge lender you go to is same exact strategy. It's not even all their money.
Not always.
Not always.
Not always.
Not always.
But like if I had $25 million, I can go to Bank of America and get a $50 million line of credit. I may keep $10 million in the bank for the rainy day if I have to.
Of course, yeah.
If they
I'm
call
sure
my
there's
money,
liquidity
but
requirements.
yeah,
and stuff
so
like
you
that.
do that, but you take 25 and you go borrow $100 million, and that money costs you 3, and then you go lend money at 6.
No, of course.
8,
That's
10
how
with
that's
points.
how banks work.
Yeah, with
It's the same
points, it's
thing.
great. I'm glad you brought it up because I've been hearing it so much more. Let's start a hard money business. I'm like, hard money. I don't, you got a servicing. It's a disaster. I mean,
Well, we've talked about just doing like a pref equity fund for other people because it's the same thing.
Yeah, we've thought about our own equity, going to get agency debt at 65 or bridge debt at super low leverage, lower rates, and then put a piece of our equity in as a pref. So they get a preferred return. Then everyone else benefits from that. So, I mean, my buddy just did it on a deal, but I think it's a great structure.
Yeah.
Yeah, you've seen it a lot, especially on like larger development. So a lot of these really massive groups, like Moynihan as an example, they'll go in and they'll lend on these super high-end, 9-figure development deals in the city. And they're expensive money. They could be 7, 9, 10% or whatever it might be. And again, not that they're looking to loan to own, but should anything ever happen, they're very well positioned to step right in and take over a position. That's the last thing they want, but they're prepared for it.
Yeah.
And they can.
In the meantime, they're clipping a very nice coupon. They took on obviously a much more, risky profile of deal, where not a lot of lenders are playing in that space these days, whether it's a high-end condo deal or whatever it might be, and they feel comfortable with the deal, and they're getting in at 65 or 70% on the dollar.
Yeah, it's like the best position in the world to be in. I wish I had more money. Making 7-8%, people underestimate what that's really worth over 5, 10, 20 years. You don't have to make 25% on every deal.
No, I mean, especially when your last dollar is in there at 65 or 70%, and you have so much room for error on a deal for, something to go sideways, which, listen, it happens. Not every deal goes exactly as everyone has planned. So it's nice to have that wiggle room.
Yeah.
With this line of credit, you could always make a cash offer and buy property in a day, too.
Exactly. It gives you so much flexibility. If you have, money, here you go, boom, cash close. We've spoke about that in here using, some of our investors, close in 15 days, but we're not going to give you 7. We're going to give you 4.5. Do you really want to sell?
Right. Massive competitive advantage.
Yeah.
A couple of my clients go and buy in cash and then always come back and refinance post-close.
I'm sure that's easier for you as well.
Definitely easier for us. No
Time,
no TOE or, no gun to the head. Definitely like that. But I mean, listen, right? It's not a common position for your everyday real estate investor to you buy a $10 million deal, even to front it for 30 or 60 days, right? Yeah. I mean, it's not, hey,
no, you're tying up a lot of cash.
Get me $10 million instead of 3. Yeah. Right. That's quite the difference.
No, for sure. Awesome. I think this has been awesome. Obviously, we don't want to go on forever, even though I'm sure we could. Thank you so much for taking the drive out and doing this. I think this was awesome. I learned some stuff. I'm sure anybody listening is going to learn something. If anybody wants to get a hold of you guys, learn more about you, Walker and Dunlop, the platform, ask you for lending options, where can they do that? What's the best way to get in touch with you?
Call me.
Give them your number.
201-366-8040. You can get Ralph or myself. You can reach out to Chris or John. They have all of our contact information, Walker and Dunlop website. Happy to try to help.
Perfect. All right. Thanks a lot, guys.
Thank you very much.
Appreciate it.